Good day, everyone. Today we're going to be discussing a prevalent topic that's been becoming more and more in the news, and that is the share buyback program done by public companies, in which the present situation as it stands started back in 1982 when the Securities and Exchange Commission made share buyback programs legal. It's been illegal to do as such for most of the history of the stock market. And the reason being, obviously, is that it can be viewed as stock price manipulation, which, uh, given the amount of information that insiders have, would give them a basis to manipulate the stock in such ways that would be less detectable and much more malicious than would need to be, or it basically would kind of ruin the trust in the stock market at that time. Now, the share buyback programs have come into play, but they do have a few restrictions around them, meaning that you do have to announce that they're going to happen, that you do have to give some size and scope to the amount of the buyback program that is in play so that the public, the general public, can have some idea of how to revalue the stock based on the amount of shares outstanding. If you don't already know, the amount of public shares that each company has out there is finite. It may seem like it's infinite, but it is finite. And so when a company announces a share buyback program, say for I believe Starbucks just announced one for that they're going to continue a $20 billion over the course of, I don't remember the timeline, but when stock analysts view that, they're going to be able to put pencil to paper and kind of come up with a new value based upon, per share value based upon that calculation, and over time what that effect is going to have based on earnings and projections and forecasts and everything else. Now we get into the issue of just how big this is across across the board. And I mentioned Starbucks, but even Starbucks doesn't really carry a lot of weight in this. And the big problem is that this is a very capital heavy issue that's going on, in that if you look at the per quarter amount of share buyback programs, that amount is well over $100 million, oftentimes $150 to $300 million per quarter. And very rarely does the number of companies that are doing share buyback programs drop below 200, and very often can rise into the 300s. So the problem is being exacerbated by a few things which we will talk about, such as kind of the rules that surround how boards of directors need to act, and kind of how shareholders view what they want, and so which influences the duties of the boards of directors. So we'll get into that, and interestingly enough, we'll kind of get into a line of thinking that shows that share buyback programs, based on the rules and that we have and the amount of money that we see being thrown around with these programs, are almost required. And it's kind of counterintuitive to think about, but we'll go through this, and we'll take this journey down the road of what the rules are and why they put us in the situation that we currently have today. I think the first thing we should probably do would be to define some of the terms we're going to use so that we're all on the same page and know exactly what words I'm saying and what they mean when I'm using them. So the first thing that we need to talk about is, what is a fiduciary? And this is going to be probably one of the biggest words and one of the biggest terms that we'll be using, as it affects everything all on down the line. And a fiduciary is a person, an entity, or a group of people, such as the board of directors, that has a legal duty to act in the best interest of another person, group of people, or entity. Um, for these purposes, you look at the board of directors has a fiduciary duty to act in the best interest of the shareholders of a company. Some other examples are the board of directors for, say, a foundation or endowment has to act in the best interest of that particular fundraising group. They also have to act in accordance with the donors and the donors' wishes. Others are, trust organizations, trust managers. They have to act in the best interest of the beneficiaries of the trust, especially irrevocable trusts. And so this is, as I said, this is a legally binding obligation that they have. And so you find boards of directors and everything take this very seriously, and they will very rarely step outside to make any waves when it comes to this duty. Next, what is an actual share buyback program? So the share buyback programs themselves are programs in which earnings or cash on hand is used to go out to the open market and place bids on stock for either a certain price or at the market to buy back the stock and place the stock in what's called treasury stock. And treasury stock, for all intents and purposes, is just stock that has been retired. It's been taken out of circulation. It's held on the balance sheet because it has been issued. It does exist, but it can't be resold back out to the general public. So when they buy that, they're essentially retiring that group of shares that they're buying. And that removes what we call, the float. And the float is all currently available shares that are being traded. So we call that the undiluted total share amount. And that is the total that is divided against the total earnings of the company. So if you have 1 million shares outstanding and you have $1 million in net income, your earnings per share is $1. And you kind of start to get the gist of where we're going with this, as share buyback programs would then reduce the shares outstanding. So if you put out that we're going to buy back 100,000 shares, then you would have 900,000 shares outstanding, but that $1 million of earnings likely stays the same, because that $1 million or whatever money you're going to use to go out to pay for that share buyback program is either cash on hand or it's through the earnings of the company. And since it's taxed money, it's not going to affect the underlying net income. It will affect cash flows on the third part of financial statements, but it won't affect traditionally the net income. It'll affect the balance sheet a little bit, but in the effect of cash on hand drops and equity drops. But for the most part, you're going to find that the goal of this is otherwise to reduce the number of shares outstanding so that you can have some artificial earnings per share growth. So off of that definition, we'll just come right out and say it, and it is a method in which you use cash on hand that would normally, for years and years and decades, would be used in what we would consider to be capital asset participation or purchases, and for that, it's just building factories, adding locations, building up stock reservoirs so that you aren't subject too much to supply chain constraints, giving raises, hiring more employees, all these things that capital is used for. Well, now it's looked at that used for share buyback programs. And the reason gets back to what a fiduciary is. And so the board authorizes share buyback programs, and they look at a share buyback program saying, well, the stock out there is trading at a multiple of, say, 10 times earnings per share, and it's currently at $1 per share, like our example earlier, and so it's trading for $10 a share. Now you go out there and say, well, we're going to buy back half the shares outstanding, and this is obviously a little hyperbolic of how much there would be buying back, but that would increase earnings per share to $2 because you're removing half the shares off the table that would be outstanding. Well, that multiplier doesn't change. The market is still trading stocks that is, say, a 10 multiple. So now your share price has gone from $10 to $20. And if you're sitting there and you didn't participate in the share buyback program, meaning they didn't give you cash for your shares, your stock value just doubled, as long as the company's earnings and everything else stayed consistent during the share buyback program. A little bit of a caveat, but that's understandable. Now you have to consider that growth against what they would have spent the money on otherwise. Do we add, say, 6 new locations of coffee shops around different areas of markets that we haven't been adding them to lately? Well, in that instance, you look at the potential return on investment, and you have to figure, what do we project? What are the projections of what we're projecting? So the potential of that. So is it a 70% chance that we're going to actually realize an X amount of potential returns? And you have to actually go out and compare that against what a share buyback program would do. And the problem that we're facing is that the share buyback program is consistently winning in the comparison game. It's consistently beating every other opportunity or every other option for capital investment. New factories, new locations, new employees, none of that is beating what a share buyback program can do for a return on investment. And so the board of directors, looking at that, and is looking at what to do with the cash and the earnings out there, basically only has 2 choices. A, they can pay it out in dividends, which a lot of companies do. Or B, they do a share buyback program, because investing the capital in anything else really is not nearly as attractive as the return on investment of those first 2 options I mentioned. And the dividend really only wins when you're in an industry in which dividends are more or less expected. So bank financials, you're looking at long-standing blue chip stocks that pay dividends. Companies that don't are your Microsofts and Dell and others that are more tech oriented. Tech stocks really don't pay dividends all that much. Energy stocks do pay dividends, so they're expected to pay dividends. So it kind of goes by industry, and if your stock is, value is based upon dividends, then you're going to be much more concerned about your ability to pay dividends over time than you are about share buyback programs. But for most of these stocks that you're going to hear about, sometimes it's a mixture of the two. So we're going to pay some of that out in dividends, and we're going to buy some stock back so that A, your dividends go up, and B, your share value also goes up, which really makes shareholders happy. And from that, you're seeing where the board of directors, their hands are tied. And so our current system of rules that we have in place for fiduciary duty, and who the board of directors fiduciary duty is pointed towards, is the shareholders, you come into a situation that they can't really invest in the things that we think that companies should invest, or maybe even just pay higher salaries, unless A, the employees are the owners of the company, so if it's an employee-owned company, or B, that capital investment can beat out the ROI, or return on investment, of a share buyback program. And then that second one just isn't going to happen. So the question that you may have is, okay, so what do we do? How can we rectify this situation? And really the short answer is we have to go back pre-1982 and just disallow share buyback programs again. Now you might say that just might go back to paying dividend. They might just go back to paying dividends and stuff. And really that's fine in reality. And the reason is you're going to learn and maybe some other ones, recordings that I'm going to do, is who actually owns most of the stock, and you'll be surprised. It's vast majority of the stock is owned by anyone that has a retirement account, a pension fund, or anyone that works for a public institution that has a government pension. Those are all invested in the stock market. So if you, and this is getting into the weeds on this one, but long story short is that most people actually are the owners of the stock rather than just a few select individuals. So we won't go too far into that one, that little tidbit of information. But in reality, what you have to do is make stock buyback programs illegal or disallowed again. And to do that, you'll just need to contact your representatives and grassroots the campaign. It will take quite a while to do, and your representatives need to hear from you for them to take on this issue. You can even write letters to the SEC that you feel that this level of stock price manipulation, even if it's fully transparent and announced ahead of time, is still antithetical to the workings of our capital market system that we're currently underneath. So that would be my suggestion. If you wanted to make a change, some people may not want to make a change, and that's their prerogative. But for the whole thing, I would say that you look at the companies. Getting a takeaway from all this is you look at the companies and what they're doing. I hope you have a better understanding of why they're doing what they're doing, and that's really why I'm putting this out there. Is that when XYZ company announces a share buyback program, you have to understand that it's not necessarily greed that's driving what they're doing. It's a set of rules that kind of coalesce into the land of unintended consequences. And frankly, we've gotten so far into that level of unintended consequence that we've created a monster of our own making, and created a situation in which capital is now not being invested where we normally think it should be, and that's too bad. But anyway, I hope you've learned a little bit today. I hope you come away from this a little bit smarter. If you have any questions, obviously sound off on the comments below. I'll do my best to answer. And I hope all of you have a great day. Thanks.